Hi, folks. Trisha Curtis, CEO of PetroNerds and host of the PetroNerds podcast. Welcome back to the PetroNerds podcast. This is episode 54. I just did a podcast recording with David Ramson Wood with Hot Take of the Day, and I thought I would just jump online and sort of do some topics. There's a lot going on in the world right now. I mean, I always say that, but it's really an unprecedented time. So I'll probably title this podcast Unprecedented Volatility. It is Tuesday, August 2nd, 2022. Right now, we're seeing WTI at 95.78. That is up from, I had actually seen October futures look at 92 yesterday. Brent is 101.91. That's up a couple bucks as well. Nat gas is 7.89. Dutch TTF, we're looking at a whopping almost $61 an MCF or an MMBtu right now. And the 30-year mortgage rate we've seen come down to it's come down to nearly 5%. It's 5.05% as you're seeing on CNBC. And that's because the 10-year yield, which largely tracks with mortgage prices, the 10-year yield has seen pressure coming down. It's at 271, but so when the 10-year yield comes down, that usually helps with a 30-year mortgage rate, and we'll get into that and talk about that for a little bit. So what I would like to do and talk about today is sort of what's going on with oil prices. I want to touch base on what's happening within Nancy Pelosi, the Speaker of the House, has a touchdown in Taiwan. So she has actually visited Taiwan. So if you've seen Asian stock markets or the stock market in general, there's a lot of tension with that right now. And then I would like to get into talk about Walmart's earnings call, recession, 9.1% inflation that we saw. I want to touch base on Liberty Oilfield or Liberty Energy's earnings call and a couple things that came out today within or last few days. We've seen from the Federal Reserve, from the New York Fed, we've seen updated numbers on U.S. household. And we've also seen some stuff from earnings calls from companies like Exxon talking about the state of the market. So Exxon had a few really great charts in terms of refining capacity and prices, which I think are excellent, that I would like to get into. So to just top this off, I think right now what we're seeing, where we saw pressure on oil prices, when you've seen that pressure on oil prices in the last couple of weeks, that has really been concerns about economic growth, concerns about a recession, concerns about the health of the economy, health of the consumer, and how much they're actually, buying crude oil. We've seen prices come down. We've, Brian Deese with the U.S. White House, with the Biden administration, has been bragging about, lower fuel prices. And largely those lower fuel prices, part of it, we saw a peak basically in gasoline, not just gasoline, but U.S. petroleum products, petroleum supply that you see from the EIA. We saw that peak in December of last year, and that's kind of come down, not dramatically, but it's come down since then. And July is usually a very resilient driving month, and that has actually, we saw gasoline demand come off in July, partly because that's when we were seeing oil prices really peak. So that's been part of, recession worries and concerns and actually just health of the consumer. That's weighing on oil prices. I think you have to, obviously traders are part of that, but watching oil prices and seeing, where they go is going to be a very big deal. I really think we're going to see oil prices lower toward the end of the year as the economy, geopolitical volatility can certainly keep oil prices up, but I think we're going to see oil prices come down overall from a demand standpoint. Obviously, natural gas has been surging. So U.S. natural gas also went up because of, we saw that the Freeport LNG export facility, assuming that they were going to come online a little quicker. So that helped prices a few weeks ago. But really, it's been about Russia not increasing those flows. So that 20% flow of gas. So basically, the Nord Stream 1 pipeline was at when Russia put that pipeline at maintenance, and then they brought that back online. It started at 40%, and then they reduced that to 20%. So Europe is very low on natural gas, and that's why we're seeing not just U.S. prices, but obviously Dutch TTF prices come up considerably. So right now, what we're seeing in this recent surge in oil prices is that folks were concerned about recession and everything, and with the U.S. GDP print that came in negative for the second quarter as well as the first quarter, so it is a technical recession. But now everyone's looking to the OPEC meeting and saying that Saudi Arabia probably is not going to increase output, even though Biden asked for it, and that's why we're seeing oil prices come up a little bit, and probably just geopolitical volatility and tension. So with all that geopolitical volatility and those tensions, the biggest thing on the market today is, I think, the biggest thing weighing on folks is that Russia has reduced those supplies to Europe. We are seeing really serious and significant implications for Germany and for Europe as a whole. They've had very unseasonably high temperatures over the summer. In the past several weeks, those are coming down a little bit, but not too great. And I was listening to BBC, and they were interviewing folks in Spain, and I was talking about this on David Ramsden Wood's podcast. But very interesting is that, so in Spain, they're interviewing folks who are trying to beat the heat, and what they're doing. They're saying, well, you could go to a mall and you basically cool off. Well, Spain has instituted caps for air. They call it air conditioning. They've put in caps for how much you can cool or have the air conditioning for temperatures. And so 27 degrees Celsius is that cap, and that equates to 80.6 degrees Fahrenheit. So that means your air conditioning can only go to 80.6 degrees Fahrenheit. That's pretty significant when it's already hot out and you're trying to cool off. And then really, really even more significant is that they have capped the heating temperatures, which come winter, to 19 degrees Celsius, which is only 66.2 degrees Fahrenheit. I think that's really, really serious from a health standpoint. We saw that, and I mentioned this before on lots of podcasts, is that the European Central Bank came out, over a year ago, and said that when they were talking about the energy transition, they were talking about inflation. They were saying they were willing to accept higher bouts of inflation because they were looking through the energy transition, and they were saying then that consumers were not adequately, heating their homes, because that the average, a lot of folks within Europe were not adequately heating their homes because of the cost. So I think that's a really big deal. That's very, very significant. So on top of that, in Europe, what we're seeing is we've seen Olaf Scholz, the Chancellor of Germany, basically he's advocated, and they're looking to institute this. And I'm not sure if it's fully been implemented, but they're trying to institute a 15% cut of natural gas consumption within Europe because of these reduced flows on Nord Stream into Europe from Russia. The real difficulty with that is that Germany, they are pass through countries, so they take in a lot of natural gas from Europe and then they pass it on. But they are not. They're the single biggest consumer of natural gas from Russia, so the dependence on Russia is far more significant than other countries. And so they're asking the whole of Europe to take in less natural, or use less natural gas. And so part of what Spain is doing is trying to comply with that. Now, I believe that's only a 7% reduction, when the Chancellor of Germany in Europe is asking for a 15% reduction. And the ramifications of that, I think, are really, really big. And that, yes, this is we're seeing these high prices, and those are probably going to be maintained, but it's really about supplies, whether you can access supplies. And so if you're trying to institute these reductions, if industries and companies are complying with that, you're going to see industries not with less power, which means they're producing less, which means the knock-on effects to the economy are going to be producing less output, producing less components. So you're going to have job losses. You're going to have real serious ramifications to the economy. We've already seen the utility provider Uniper has gone has basically, Germany has come in and taken a 30% stake in this company. The government of Germany has taken a 30% stake in this company. And I think that's the very, very beginning of what we're going to see in terms of serious, serious energy crises in Europe. And I think it's important to point out that before all of this was taking place, this was taking place on the back of, before Russia actually was meddling with flows out of the pipe, out of Nord Stream. We were seeing energy crises in Europe. And I've talked with clients about this. It's been in presentations, and I've talked on the podcast about it a lot. But we've seen, we saw basically UK and Europe as a whole have issues with energy last fall. And so if you remember, when oil prices did their first ratcheting up, basically last October, where they went to $80 a barrel, that was on the back of a lot of fuel switching. So that was when we saw a lot of folks in Europe actually switch their power plants from, if they could, they were switching their power plants over from, if they were using natural gas, they started using oil. And so we had about 1 million barrels a day that was estimated, maybe more, maybe less, in terms of people were switching from natural gas to oil. And obviously at $60 an MCF, oil prices are significantly cheaper. So if you could have done that, you probably already have done it. So there's probably not much there. But that was a big push for an additional volume, additional demand on the oil side to help propel oil prices forward. And so from the natural gas standpoint, it was cheaper. Now this is really about a supply, being able to actually get that supply and the ramifications for that. But I do think it's important to point out that happened sort of as we were seeing serious energy crises within Asia, particularly within China, where we, last fall, if you remember, we had cities that were without power for weeks on end, for months actually, that a lot of folks didn't hear about because they had coal shortages, and they had, 17% of China's grid is hydropower, and they didn't have enough. They didn't actually have enough rain, and then that solar and wind was really cumbersome because in really hot heat, you don't have enough. When it's really really hot outside, often the wind doesn't blow, and yeah, that can work for the sun, but the problem is in Europe, and I know at least for the UK, they didn't actually have enough sun, so solar power generation was down. So what happened was last fall you saw solar power generation down in the UK, you saw wind power generation down, and so all renewable power generation actually was down, even though you had the capacity, and so they were drawing really hard on what natural gas they had, and that was really the point where we realized they don't have a lot of spare natural gas. They don't. Europe does not actually have a lot of storage for natural gas. So in the US, we are blessed where we actually have, everyone's looking at the storage report every week. So we actually store it. We have inventories. They don't really have that in Europe, and they've relied heavily on those pipelines, heavily on those supplies. If you look at the Energy Information Administration, and I show these slides a lot in my presentations, you can see they put out their daily, they do a daily thing, which is absolutely fantastic. And they have one on, if you look at European gas consumption and production, you can see that their production in Europe, overall, Europe and the UK, production for gas has really declined over the last 10 years considerably, hence, their vulnerability to imports, but their consumption has really stayed flat. And so when you don't have storage and you don't have infrastructure, you're not increasing, your production. And COVID, really helped exacerbate that because you saw a lot of, I mean, there was issues with getting people to offshore in the North Sea. They had maintenance that they needed to do that wasn't being done. So you've seen a lot of lags from COVID helped build up on the gas side, and you saw natural gas prices were just so low that the fears and concerns about natural gas and weren't really there. And this was really, I think, exacerbated by really intense green policies agendas within Europe that helped exacerbate all these problems. So taken together, that was happening before, and now you have obviously the war in Ukraine and reduced actually flows of natural gas into Europe. And so you truly have an energy crisis. I think folks have talked about it before, but this is really, really serious. And I think it's one of the single biggest things we're going to see. What could really impact the global economy is this European energy crisis, which is obviously a global energy crisis. And I think in Germany, we are already hearing and seeing that, what's going on the nuclear side. I'm not quite sure. I assume that, any nuclear capacity that Germany was planning to roll off, because they were planning to uh, take those out of commission. I'm assuming that they will try to delay those as much as possible. When it comes to coal, Germany has a very significant coal constituency up, I believe, in the northeast part of Germany, and it is several thousand jobs. It's still several coal mines, and the reason they've maintained this is they don't talk about it a ton, and that's why the grid is still still over 30% coal is the German grid. And so in many ways, that's actually probably very positive in terms of an energy security standpoint because they're producing and supplying, their own power in that regard. But it's sort of survived all these green policy agendas because they have a very strong constituent, very strong political base within the area that's advocated very strong for those jobs, and using the use of that coal. So they have a chunk of it. I'm assuming that they will try to ratchet up production if possible. But we are hearing, and you're hearing on BBC and others, that they are planning to basically ramp up coal-fired power generation in the winter. And I would assume that we're going to see that start as soon as possible because you're going to try to offset any natural gas that you're using now and try to save that. So that's going to be very tricky. But I think it's really case in point in terms of sort of the energy security thing, which I've tried to talk a lot about in terms of if you're thinking about energy security, and you're thinking about what would the trajectory of natural gas demand and trajectory of coal, obviously Europe not getting enough natural gas from Russia is going to throw a kink into what the future of natural gas demand looks like in within Europe. But I think when it comes to coal, the decline that projections we see out of the International Energy Agency are just completely unrealistic. And I would say that I would bet a lot of money on coal consumption being significantly higher than almost every forecast has said they would be in the last couple of years. So I think coal production or coal consumption is going to be very, very high over the next several years and continue because it is simply very, very stable. And what we're being taught from this war in Ukraine and these energy crises and geopolitical vulnerabilities is how stable coal is. And come this winter when temperatures really cool off, and I think or Europe will have significant geopolitical vulnerabilities, that's going to be a real problem for them. And I think they're going to choose to actually produce energy through coal because that's all they have. And we will see the importance of that. And I think that brings us to China. I mean, I sort of have a running thread on China throughout, my presentations and podcasts, but I would say that, on China, what we're seeing, I mean, China has increased coal production by 100 million tons in the past 5 years. So they're nearing about 400 million tons of coal production. That's really, really meaningful, not just in the context of energy security, but what they actually want to do and why they want the energy security and why they want to be, stable from everyone else. But I think in terms of how much crude they're getting about 2 million barrels a day of crude from Russia. They import roughly 10 million barrels a day of crude. They produce about 4.5 million barrels a day. China does. And so about 2 million barrels a day right now is coming from Russia, give or take. We are seeing increased flows on pipelines on the natural gas side. They're getting a ton of grain. The purchases of China, the flows of money from China to Russia are massive and have really ramped up in the last several months, before the war in Ukraine and during the war in Ukraine. But when it comes to energy, I think when you look at what China's importing, you're getting about 2 million barrels a day from Saudi Arabia, 1.5 million barrels a day from Iran. So right there, you can just see that over half of their imports are from countries that they have very good relationships that they rely on. And the reason this is all relevant, is because right now, Taiwan is a significant issue, not just a significant issue geopolitically and what it means for China and what's been going, statements that Biden has made over his year and a half, in office. But really, right now, Nancy Pelosi, the Speaker of the House, has touched down in Taiwan. So she's in Taiwan as we speak, or maybe she's left. But Taiwan produces a massive amount of semiconductors. So there's some excellent podcasts that you can listen to on this. But the majority of the world's semiconductors is coming out of this is coming out of Taiwan, is coming out of actually one company. And so any volatility in Taiwan, and what I mean is any volatility in the Taiwan Straits, any ability to, the impact of supply chains on just getting these semiconductors out is going to impact chips, is going to impact everything that chips go into. So we're talking high end chips, obviously for phones and computers, but we're talking across businesses that would have a significant impact. So if you're looking for sort of a black swan, event, that could certainly be one of them. That is another thing that's sort of hurting the economy. So it's absolutely something to watch for. I know that a lot of academics and a lot of policy folks in DC and think tanks, when the war in Ukraine began, there was a lot of analogies saying, is this what could happen in Taiwan? And I think it was discounted by many that it's not the same thing, and it isn't. The Ukraine and Taiwan are two different things, but if you read the joint statement that, and I've talked about this a lot in previous podcasts as well, but if you read that joint statement between Russia and China that they put out on February 4th, the war in Ukraine was February 24th. If you read that joint statement, it talks about there are no areas of forbidden cooperation, and it does also talk to basically both countries supporting each other in their territorial, ambitions. And so obviously China has a significant territorial ambition, to reunify Taiwan with China. And that's been something that's really big, where you've seen the Biden administration, you've seen Biden talk multiple times of, what they say is, people have called goffs. You say he basically says something on Taiwan, which says we will defend them if something happens, and then his folks within his team basically walk that back or try to walk that back. And this has been difficult for the administration and folks in Washington, because Nancy Pelosi has actually received a lot of bipartisan support on this trip to Taiwan, as basically she's one of the highest. I mean, she's actually in office, so I believe she visited 25 years ago, but the highest, or she believed, decades ago, but she is the highest ranking official, to visit China, to visit Taiwan in, over 2 decades. So basically, in 25 years, she's the highest sitting, official to actually visit, and that is significant from a, uh, whether it's just a visual standpoint, whether it's meaningful. China has responded pretty aggressively. We saw Asian stock market, off kilter, and some fear trades going on last night. But I think China's response to this, we will see them. They're already saying they're planning, increased air stuff going on above Taiwan. So we will see increased flight traffic. We will see all kinds of military stuff, testing, and just basically, I think it's not just flyovers, but essentially these are international waters, which China deems theirs. And I think the goal of reunification is something that will probably come into fore. If you've studied China, if you're looking at what's really going on within China, things like energy security, things like food security, things like the war in Ukraine, their tight relationship with Russia, what's going on, their takeover of Hong Kong during COVID, the mass lockdowns that we've seen, the Institute of Controls that we've seen during COVID, very similar to the Institute of Controls we've seen, in the province of Xinjiang with the internment of these Uyghur Muslims. That's all coming together, and I do think that there are probably scholars that are really seeing this is a much bigger deal than people realize. And so the issues with Taiwan are not something that we can solve in a podcast. And I would certainly like to talk about it more and get some experts on here. But it's something to watch, and it's the reason why you're seeing volatility in the market today. So next, I would like to talk about U.S. inflation rate was very serious. We saw last month the U.S. inflation rate come out at 9.1%. That's extremely high for a developed democratic country. Obviously, we're seeing inflation across board in across Europe, in the UK. They are not at 9% yet, but they're coming up very, very closely. A lot of this is energy, but it's not just energy. So electricity prices are up 13.7%. That's really, really serious for the U.S. consumer. But we are also seeing we're seeing energy prices up. We are seeing electricity prices up. We're seeing nat gas, crude oil, but we're seeing food prices. And I think we'll talk about the Walmart earnings call in just a second. But that food inflation is really, really serious for not just the American consumer, but the global consumer. And so when we hear about food and energy crises, we do have a food and energy crisis. And energy particularly natural gas and the production of fertilizer and fertilizer for food is a huge component of that. But we've also had just food crisis. We've had food inflation in the U.S. Well, partly because of so much stimulus measures in the U.S. And entitlement programs and things that we were sort of leading on food inflation for good or for bad. I'm not making a judgment call on that, but the reality is that when you increase entitlement programs, it typically leads to inflation, and that probably wouldn't have been so evident if we didn't have so much stimulus in the system. And so $27 trillion in global economic stimulus between fiscal and monetary policy, and the more dollars in the system than the Fed has ever printed is really, really serious. And so leading into that is something that the Federal Reserve is having a really hard time dealing with. I mean, they came out last week and talked about increasing the Fed increased rates by 75 basis points. So and that talk was pretty hawkish in my opinion. I mean, I think the Fed actually coming out and saying, if you listen to the Fed speech and you listen to Jerome Powell, there are a few scary things he mentioned. And one is that he mentions food directly. He mentions that people are actually eating, consuming less food because of the cost of food. If you look at the actual inflationary data, you can see that food at home is far more expensive than food out. So if you're going out to restaurants, the reason that is because restaurants are afraid. Obviously companies like McDonald's, Olive Garden, companies like that are if you're catering to a certain consumer, and if you ratchet those prices up too much too quickly, you're going to lose that consumer. So those companies actually, McDonald's may be a company that actually does quite well or low on cheaper food because people are actually looking for food at a better price. And if you go to the grocery store and you're looking at the cost of bacon, I mean, it's out of this world. You can see on inflationary data from Bureau of Labor Statistics that our beef prices are out of control. So you can they break down eggs and milk and staple products, and you can see these prices. So they've accelerated considerably and are really, really high. And actually, many of these, if you look at 2008, 2007, 2008 levels, and then you look now, many of these are well over those prices, including, electricity prices have just continued to ratchet up. So those levels of inflation are really significant in the US, but they're significant abroad and have huge consequences for geopolitical volatility, obviously just accessing food and fuel in Europe, but I think abroad as well, having a food crisis of in the US where the prices may go up, but we're going to have access to grain because we produce a lot of it, whereas in other places around the world, and that goes same for natural gas as well, but in Africa, in certain countries that have to import a lot of this, that is really problematic. And actually a lot of these countries in Africa and Middle East that produce grain are having trouble accessing fertilizer for their crops. So it's a double-edged sword, and it's really complicated that they can't produce this stuff because they haven't had the fertilizer. Okay, so we're going to switch gears just for a second to bring this back to the inflationary piece, and we're going to come back to energy, and we'll talk about energy prices, some stuff from Exxon's call, and energy transition. But if you look at what Walmart said, so last week, we had the Fed come out, we've had earnings coming out, and lots of stuff has been going on. And what you're hearing and seeing in the stock market is that we're seeing this in the 30-year yield, or in the 30-year mortgage prices. We're seeing this in the 10-year Treasury yield, and what's happening is that the market and people are saying, well, look, the economy is not that good. We actually are seeing a recession, even though Janet Yellen and Jerome Powell are saying, and many others in the administration and Biden himself are saying we're not in recession, even though a technical definition of a recession is 2 consecutive quarters of negative or slower economic growth, which we've seen use GDP data. We actually have that for the first quarter and the second quarter. We're in negative territory. So we are in a technical recession. I'm an economist. I was trained that way. Technical recession, 100%. So even though what the market is reading that and saying, okay, well, we have this technical recession, which means the Fed is going to have to stop raising rates. So they're going to have to lower rates, and we're going to see this accommodation, and therefore stocks will go up. They're very, very inaccurate. So I would not look to stock prices as a gauge of where the economy is at. So they are still way overinflated, and they need to come down considerably for where probably the reality of the economy is at. But they're not also, that is a poor interpretation, because if you listen to Jerome Powell and you listen to the Fed, what he said was he was very strong on inflation. Now he's extremely late to the party, and I've said that multiple times, that Jerome Powell has, he didn't have job security. He finally got his job security, and then then he got it, and then he got serious about inflation, of tackling inflation. It became a problem. It is extremely serious that the Fed gets a hold of inflation, because you cannot have, they have a dual mandate, which is, employment and price stability. They don't have price stability, and they have very low unemployment, but you cannot have a healthy employment environment going forward if you don't help with inflation. And the reason we're seeing recession in the first place, the reason we're seeing any kind of slowdown or pullback, is because of these high prices and what it's doing to the consumer. And we're seeing that in, so if you listen to the Walmart earnings call, and I haven't had a chance to listen to it, I've skimmed through it, but if you heard the craziness from the Walmart earnings call last week, right before actually the Fed talked, it was really serious. You had a lot of commentators talking how, well, the rest of the country might not be in recession, but the bottom 40%, the people who shop at Walmart, are. And, there are people, lots of us shop at Walmart that are, wherever you're talking, bottom 40%, middle 50%, 60%, whatever it is that the reality is a lot of, companies like Target and companies like Walmart and Dollar Tree and stuff do well in recessions because they're cheaper, and actually their stocks should go up. But the problem that we're seeing with Walmart is really case in point of the dynamic complexities that we're facing right now. And that's that the consumers at Walmart don't have enough money to buy anything but food and fuel. So they're fueling up their vehicle and they're buying food. And so we heard within the earnings call, we heard about too much inventory. So they had too much inventory, and that's what Jim Cramer and many others were criticizing them for having too much inventory. But the problem is that it's not just, okay, so we had too much inventory, and their criticism is that they should have known their consumers better and they shouldn't have the inventory. And then they're spending all their money on food. And we heard it in the previous earnings call, but also in this one, that the consumer is buying local, like the private brands. They're not buying name brands. They're buying the Walmart brands because they're cheaper. So that's happening on the food side. So it tells you the state of these consumers and the state of the economy. If you're living paycheck to paycheck and the prices are going up so much, you're switching your brain consumption. And the impact is that they're just not buying these discretionary items. That's why companies like Netflix, several quarters ago or a couple quarters ago, which we talked about in previous podcasts, is that, people were starting to change their behavior patterns of, they had a decline in consumers for the first time, decline subscribers for the first time ever. And that was a couple of quarters ago. So if we're looking at this now and saying we're finally seeing this at Walmart, where, the consumers at Walmart are really, they're not buying the discretionary stuff. And I think that we're going to continue to see that. You're going to continue to see that pain that's happening in those places because of that inflation. So obviously, Walmart missed on earnings, and that was part of it. But it was really, I truly believe it's like, if you're looking for the health of the economy, you're looking for bellwethers, you need to look at companies like Walmart. And the reason why is because when they say things like this, so they say, quote, while we experience high levels of inflation in international markets over the years, U.S. inflation being this high and moving so quickly, both in food and in general merchandise, is unusual. We'll control what we can control, reduce our inventory level, and keep prices as low as we can, especially on opening price point food items, while improving our profit performance. So, what Walmart's saying, and I'm not saying they're completely right in this, but they're saying they have inflation in food and fuel. They also talk about in shipping containers and what they're doing. So, the food and fuel prices that they are seeing, that they're trying to control, but they're pointing to the fact that they are never seen these levels of rapid inflation in the U.S. In Walmart, the leaders of Walmart obviously haven't experienced it. So what the impact of their business is significant. I think that's really being underappreciated by the market right now. So, and on top of that, so I mean, we can pause on that, and I'm sure I'm going to be talking about Walmart earnings and lots of other earnings calls, including Target and others, in next podcast. But I think that's really important to think about. We also had New York Fed came out with their quarterly report on U.S. household debt and credit report, and we did see an increase. So we are seeing over 16 trillion. We had ratcheted up over $1 trillion in debt in 2021 alone, and now we're over 16 trillion in household debt in the U.S. That has come up. We saw credit card debt come up, and we saw mortgage debt obviously go up. But so non-housing debt is 4.45 trillion, and housing debt is nearly $12 trillion. So huge amount of household debt, being housing debt because of the high prices of these homes for the U.S. consumer. Lots of debates that I've had on the health of these mortgages and what they actually look like, but it's certainly something to watch. Just because if you're looking at the size of a mortgage in 2007, 2008, the size of that mortgage was around $200,000 versus the size of a mortgage now is up to $450,000. So the reason it's so relevant is not that there's not the health of that mortgage isn't great, but it's that if you have a dual income family and two people are making those payments, if one person loses their job, those payments might seem really high. I also think that's really important that a lot of these folks have also not had to pay off. These people have not had to pay off student loans, and so student loan debt is not. We're not factoring that in terms of what does the consumer actually look like. So when we hear about how healthy the employment side is, how healthy the job sector is in the U.S., and that's why we're not in recession, and we hear about the health of the consumer, I think the health of the consumer is really masked by the stimulus and fiscal lags, and part of the reason why we haven't seen enough people go back to work, and that's creating and exacerbating the supply chain problems and inflationary problems that people are seeing. But it's also that those fiscal lags are really serious, but that the not having to the actual not feeling the employment side yet. So we're hearing companies like Tesla and Ford and others talk about curbing employment or job layoffs. We've seen it from Microsoft, Google, Apple. I mean, you name it. Everyone has. Goldman Sachs has all come out and started talking about job losses, but the average person isn't feeling it. When they start feeling it, I think this is going to change. This is going to change course really, really quickly. So if you break down this debt levels, we haven't obviously seen student loans, considerable increases, but student loans is 1.6 trillion. Auto loans are 1.5 trillion. So, I do think it's serious when people are talking about the severity of student loans, and those are really high, right? The interest rate on those are really high. The government could do more in terms of reducing the interest rate on those loans or making sure they pay off the principal than just creating a moral hazard issue and forgiving all those loans. But if we're talking student loans being an issue, 1.6 trillion, I think we do have to think about that's far more about voting and voters and getting those votes than it, because auto loans are 1.5 trillion in debt. That's household debt is auto loans 1.5 trillion, and that is not healthy debt. That is not. These are not healthy. We have a lot of subprime auto loans. If you have a Pulse, you can buy Escalade. I think the auto debt is really, really huge. We have less than $1 trillion, just shy of of $0.89 trillion in credit card debt, and about less than half a trillion in other debt. So that's the non-housing side. So those debt levels are, people keep watching that. We don't see massive delinquencies, but I do think, we are hearing across the board where payday loan things are increasing, quick loans, people getting cash. We're also, and again, not across the board, not every single person is doing that, but a lot of folks are doing that. Folks living paycheck to paycheck, I think that's extremely serious. And we are seeing credit card debt obviously increase as well. And that's something to watch closely is your types of consumers, your types of credit card debt. Okay, and lastly, I'm going to close with I'm going to talk about, we've seen earnings season come in for Exxon, so I will be getting into these in podcasts, but, Exxon has come in. I would say that it is interesting, to listen to Exxon and actually hear what they're saying in terms of the tone is a little bit different. Instead of being, very pro energy transition and talking about net zero and talking about board issues and activism, we have seen them pivot a little bit because they came out with their, the Biden administration wrote them a letter, which was really about really more addressing, oil prices and refining on the refining side and what was going on there. And so Exxon actually has come out with a letter in response to that. We heard a little bit about that in the earnings call, and they talk specifically in the earnings call about their increasing refining capacity. They also talk about natural gas laws. So if you're looking for like long-term trends and themes of what oil companies are doing now and how it's going to impact the future, is Exxon is talking about natural gas production volumes and increasing LNG, but that's a couple of years out. That's a few years out. Same for volumes. They are talking about increasing, how much they've increased Permian growth from now, from 2021 to 2022. essentially they're expected to see a 25% year-over-year increase. Now we're seeing, and we heard Chevron saying they've increased their rig count. They're basically at 10 rigs. So everybody's incrementally increased their rig count. And obviously, if you look back, I mean, what Exxon was drilling with 55 rigs pre-COVID, sometimes 57 rigs. And then we've seen that number just come to a fraction of that, to, I mean, just to single digit numbers. And obviously everybody's coming back a little bit, but they're not going to come back to a 55 levels. They also don't need that. So Chevron made sure to point out that the amount of they talked about infrastructure spend and the fact that they won't have to be adding all these tank batteries in the future, and they did this at much lower cost, and now they can bring this production on. And they also talked about the fact that their lateral lengths are not just lateral lengths, but what they're doing with their rigs is they need half the rigs that they did before, and essentially they need half the frac equipment. They didn't say frac equipment, but they said their frac efficiency is nearly twice as it was, in 2018, and they said that essentially for rigs as well. But we are seeing so these are sort of the trends and themes, but you are hearing justification. You are hearing a little bit of a pushback from Chevron and Exxon in terms of what the Biden administration has pushed them on. Are you increasing output? We heard questions on the earnings calls about that, but I will get into that in future podcasts. But the point I want to drive home here is related to what I opened with, and it's the energy and fuel, food crisis that we're talking about. And I think there's two charts that really capture it well, and I'm going to post these on LinkedIn and Twitter so people can see them. But if you look at Exxon slides, on slide 4, they had this, and I'll hold this up, and it's in black and white, so you can't see it really well. But they put crude, natural gas, refining margins, and chemical margins, just these bar charts and these dots, and they just show, second quarter 2021, first quarter 2022, second quarter 2022, and 10-year range. And so the bars of the 10-year range are what these prices are, and you can see they're flat across the board, right? So for all these things, for oil prices, for natural gas prices, for refining margins and chemical margins, your 10-year average, right? That's our black bar. And then you see the prices. And you can see, obviously, there's a bump in crude prices, but really, those refining margins, obviously, there's a massive, massive bump quarter over quarter. So huge. They were negative and you had negative refining margins in 2021 on the because of COVID and because people weren't using it. And so that was a massive problem. Now you have very, very positive refining margins, but we'll get to the refining side in a bit. So that's really, really important, seeing what's going on there. But it's really natural gas prices. And I think that's something that people have to realize. That's what's going to break the consumer and going to really hurt the US economy and is hurting the global economy, obviously, as we talked about with Europe. But natural gas, the bump up in natural gas prices from where it was in the second quarter 2021 to now is massive. And they don't put the prices on it, but it's the ramp up. And that's really, really huge. Now, if we look at the refining side, and I think that's really, really important that they point out, is because that's where they're getting criticism of, what's going on the refining side. Part of the reason, we've seen a really big bump in prices and a hold up in prices, even with, we know that Saudi Arabia, and we know what UAE is producing. We know that OPEC is producing nearly 29 million barrels a day of crude oil. The U.S. is producing nearly 11.7 million barrels a day of crude oil. We know Russia's had a big bump, actually from reducing output, but they're producing, over 10.5 million barrels a day of crude oil. So if we're thinking about why we had seen such high prices of oil, a big part of that was the refining side. And you've probably heard that in the U.S. we lost 1 million barrels a day of refining capacity. But globally, and Exxon has a good chart on this as well, is that they show, quote, on this is slide 5 in their investor presentation. It says industry investment not keeping up with recovering demand. So that's on the oil side. And obviously that's going to be significant for the future. But if we're looking at right now, we're looking at, I mentioned what happened in the UK, what was going on last fall within China, weather and everything, and how that sort of spurred, the switch and transition from, the spike in demand for crude oil when we were switching from natural gas, and how that sort of led that price upward in the $80 range. And then I think now is really important to realize, when we were seeing $100 a barrel and everything, even though we have flows moving around the world from Russia and those exports being maintained, the refining side is really huge. I mean, your refined product prices are a big factor of your actual crude oil price, right? That's what goes on to your gas stations, and that's why we see those prices. So we saw during COVID a lot of loss of refining capacity. So in the U.S., we saw a loss of about 1 million barrels a day. And this chart, it's on slide 8. It's fantastic. It shows the net loss, obviously a net loss of about 1 million barrels a day. A global net refining capacity change was 1 million barrels a day, but a total loss was is over 3 million barrels a day of a total loss of refining capacity. And I think that's really, really significant in terms of seeing where those price points and pain points are. It's also really important to think about the future. Again, if we have more natural gas production, if the refining capacity comes back online, and where demand levels are at. And that's why, those are going to be huge factors in where prices actually, work out in the wash. And I know the industry is not, we're not hearing a lot of anxiety over oil prices, right? We're not hearing a lot of folks concerned about oil prices dropping, and part of that's because they're very well supported by geopolitical volatility, and we've had the resurgent demand coming back from COVID. I stress this in podcasts, and I've stressed this in presentations. The one I gave at Doug, Hart Energy, and others, and to clients, is that you know we don't want to get a sort of false sense of security of where that demand levels are, because this recession, these energy crises, things going on in Taiwan, any of this could really, really curtail oil demand. And I do think important, and I want to bring this to close with Liberty, and I will absolutely be talking about service companies and Liberty's call at depth. But I really want to close this because it's just Chris Wright really nailed this home and did such a fantastic job in Liberty Energy's second quarter earnings call. But they say, in the beginning of the call, they say, quote, today, historically low global oil and gas inventories, limited OPEC spare production capacity, and a dearth of refining capacity are colliding with increased energy demand. Oil and natural gas demand growth is coming from the post-COVID recovery, etc. So back to quote, the greatest risk to our marketplace is a severe recession that leads to a drop in global oil in demand for oil and natural gas. A moderate recession typically is only a slowing in the rate of demand growth for oil. So that's something really important to point out, and I try to stress to folks, is it's that slowing, right? It's that slowing of demand that is a really big deal. So if it is that if demand for oil and natural gas just slows, that will impact price, because the prices usually run up on the ramp of the thinking about demand growth. So if that demand isn't growing, even if it's just slowing or stopping, that will impact prices. Doesn't mean they crater, doesn't mean they crash. And I do think we are going to see the absolute. We're already seeing a slowing in the demand growth. But it's really, do we curtail demand because of really serious pains in the global economy? And you can see that when your global economy slows, your demand for crude oil slows, and we will see that in China, because their housing side is slowing, the infrastructure side is slowing, and we will see that in the U.S. if and when the housing side really, really slows and we go into a deeper recession. Consumers will fly less, and we will be building less, and trucks will be shipping less stuff around because we'll be buying less. So that's all very real. Now, I think the biggest thing I want to talk about, and I want to end with, is Chris Wright's comments on the energy transition. And I am super big on this. I've talked about it a ton, across my platform, across the clients that I work with. I really do believe that the industry has got to get comfortable with talking about the fact that they are comfortable producing oil and natural gas, and talking about as oil and natural gas, and understanding how vitally important it is for energy security, and global geopolitical power dynamics. But it's also just really important that as the industry, as you've seen CEOs and industry executives cater to the energy transition rhetoric, it has been damning, for what happens in a policy arena, and what happens in a regulatory arena, and what happens from a lobbyist standpoint. So there, we have to be able to talk about this openly. We have to have leadership in the oil and gas space for producing the stuff that helps keep people alive, and keep fueling these homes, and creating stability for prices for people to actually just go about their day-to-day business. And so Chris Wright says, this direct quote, reading from him, really, really great statement. I'm going to post this all over LinkedIn. I'm going to tweet this and put this out. I think this needs to be, it's something I've said in a lot of different words, a ton. It's other folks are saying this, but I think Chris is one of the very few publicly traded companies that's saying it this clearly and specifically. And he says, this second quarter earnings call, this was from July 26, 2022. He says, quote, the world is gripped. The world is gripped today by a serious energy and food crisis that is of our own making. It is not, in fact, due to any shortage of available resources. It is due entirely to investment decisions and a growing myriad of barriers to investment in hydrocarbons. The very hydrocarbons without which the modern world is simply not possible. It is admirable that the public regulators in our industry are keen to improve the quality and cleanliness of our activities. It is not admirable that so many emotionally driven, fact-free impediments to investment have come from government regulation, NGO litigation, and lobbying, and Wall Street, too often equating lower greenhouse gas with better in all cases. The blame for the current energy crisis also falls on our industry for too often compliantly going along with the endless anti-hydrocarbon fashion of today. If it's not for us to speak candidly, honestly, and loudly about the critical role hydrocarbons play in the modern world, and most critically for those desiring simply to join the modern world, then who else will play this role? Certainly, it has not been political leaders, activists, academics, or celebrities. It is us that must carry that torch. Otherwise, the immense human damage we see today from the lack of investment in hydrocarbon production and hydrocarbon infrastructure will only be the beginning of a calamitous crisis. End quote from Chris Wright. I think that is a great way to end the podcast. That is a fantastic quote, and it is something that I spend a ton of time, taking data, taking charts, taking information to really bring people to this point. I think the U.S. production platform is huge. The ability to increase it is huge, but we have so many factors obviously impacting that. So with that, I'm going to close. Thank you guys so much for listening. Really appreciate it, and talk to you soon. Bye.